The financial lexicon recently gained a new term, the taco trade. This acronym stands for Trump always chickens out. I coined this phrase in May 2025 for the Financial Times. It aims to describe an observable pattern in President Donald Trump's approach to trade policy. This pattern typically begins with the announcement of very aggressive, often startling tariff threats against various trading partners. However, following these bold declarations, there is often a subsequent phase. This phase involves either a complete withdrawal of the proposed tariffs or a significant reduction in their severity, frequently after periods of market anxiety or direct criticism. President Trump has directly addressed this characterization of his strategy. He was asked about the taco trade label by CNBC reporter Megan Cassella on May 28, 2025. This exchange occurred during a press conference, which news reports indicate was held at the swearing-in ceremony for Jeanine Pirro as interim U.S. Attorney in Washington, D.C. President Trump described the question as nasty. He firmly rejected any suggestion that his administration chickens out on its tariff policies. Instead, he defended his actions as calculated negotiation tactics, asserting that he is often criticized for being too tough, not for backing down. The president's official explanation presents a stark contrast to the taco interpretation. He argues that initiating negotiations with high tariff proposals is a deliberate method. The goal is to compel other nations to engage in trade discussions and make concessions. From this viewpoint, any subsequent reduction in these tariffs is not a retreat. Rather, it signifies a successful outcome of these tough negotiations. This narrative directly challenges the taco trade theory. That theory suggests the reversals are often driven by adverse market reactions or mounting political pressure from affected domestic industries, rather than purely strategic concessions. The taco trade term has nonetheless found resonance within the financial community. This is largely because it encapsulates the recurring experience of many investors and market analysts. They have repeatedly witnessed the cycle-bold tariff proclamations stir market uncertainty. Then, often before full implementation or after a short period, these threats are softened or postponed. This has cultivated a degree of skepticism regarding the administration's ultimate resolve to enforce its most severe trade warnings. It also implies a market perception that the administration is sensitive to significant economic disruption potentially caused by its own policies. A recent example vividly illustrates this dynamic: the European Union tariff episode in May 2025. Just last week, President Trump announced a significant threat. He declared his intention to impose substantial 50% tariffs on a wide range of goods imported from the European Union. These new stringent tariffs were scheduled to take effect very soon, on June 1st. The news of this impending trade action immediately unsettled global financial markets. Stock indices in the US and Europe saw declines as investors grew concerned about the potential for a major transatlantic trade dispute, adding to existing global economic uncertainties. However, the administration's stance on these EU tariffs shifted remarkably quickly. Only 2 days after the initial, concerning announcement, specifically on the Tuesday just prior to May 28, a reversal occurred. President Trump declared that the planned imposition of these 50% tariffs would be postponed. The new implementation date was pushed back to July 9th. This delay, according to official statements, was to allow for discussions and negotiations with EU leaders. The market's response to this postponement was immediate and overwhelmingly positive. The S&P 500 index, a key benchmark for U.S. stocks, experienced its largest single-day percentage gain in several weeks, reflecting widespread investor relief. This pattern is not isolated. Earlier in April 2025, the Trump administration unveiled an even more expansive trade measure. On April 2nd, President Trump announced what he termed Liberation Day. This involved the imposition of sweeping tariffs designed to affect nearly every nation trading with the United States. These comprehensive tariffs officially came into force on April 9th. The sheer breadth of this action was unprecedented in recent history. It signaled a potentially drastic reshaping of global trade relationships and caused considerable alarm among economists and multinational corporations alike. Many feared a descent into a global tariff war. Yet, the Liberation Day tariffs had an exceptionally brief lifespan in their initial aggressive form. Merely hours after these sweeping tariffs took effect on April 9th, President Trump made another sudden announcement. He declared a 90-day pause on their implementation for all targeted countries, with the notable exception of China. the administration explicitly pointed to adverse market reactions as a primary driver for this rapid policy pivot. Prior to this pause, the S&P 500 had fallen to levels approaching bear market territory. Bond yields had also surged, indicating significant stress in financial markets. Subsequently, these sweeping global tariffs were substantially diluted, eventually being reduced to a baseline rate of 10%. China has consistently been a central focus of President Trump's assertive trade policies. He has repeatedly accused Beijing of engaging in unfair trade practices, intellectual property theft, and currency manipulation. To address these concerns, the U.S. administration implemented a series of substantial tariffs specifically targeting Chinese goods. Some of the initial tariff rates announced were exceptionally high. For example, certain categories of Chinese imports faced potential duties of up to 145%. This aggressive initial stance was clearly designed to exert maximum pressure on China to agree to U.S. demands for changes in its trade and economic policies. Following the imposition of these initial high tariff rates on Chinese goods, several adjustments and modifications were made over time. For instance, some tariffs that were first proposed or implemented at the 145% level were later revised downwards, first to 100% and then further reduced to 30% for specific tranches of goods. In another notable development, a significant 145% retaliatory tariff threat, which could have been a U.S. tariff on Chinese goods or a Chinese tariff on U.S. goods, though reports suggest it was against China, was dramatically scaled back to just 10%. This particular reduction occurred after a trade deal was reached between the two economic giants, showcasing the negotiation aspect. An unavoidable consequence of this approach, characterized by bold threats, sudden escalations, and subsequent de-escalations or reversals, has been a marked increase in market volatility. Financial markets thrive on predictability and stable policy environments. The frequent and often unexpected shifts in U.S. trade policy have created the opposite. This has led to pronounced swings in global stock prices, fluctuations in bond yields, and notable movements in currency exchange rates. Such an unstable environment makes it exceedingly challenging for businesses and investors to make informed, long-term capital allocation decisions, potentially stifling investment and growth. The emergence and popularization of the taco trade moniker itself offers insight into investor sentiment. It suggests that a significant portion of the market has come to anticipate this pattern of behavior from the administration. There's a prevailing belief that the most extreme tariff threats are more likely to be bargaining chips than immutable policy decisions. Reports have even surfaced indicating that some Wall Street traders have developed strategies specifically designed to capitalize on this perceived unpredictability. They aim to profit by buying assets when tariff threats cause market dips, and selling when subsequent policy softenings lead to relief rallies, a testament to the unusual trading environment. As the individual who first articulated the taco trade concept, my analysis centers on how markets have adapted. There is a growing perception among financial observers that the current U.S. administration demonstrates a relatively low tolerance for sustained negative economic consequences stemming from its own trade actions. When market reactions become particularly severe, such as steep stock market declines or sharp increases in borrowing costs, or when influential domestic industries voice strong opposition due to tangible economic harm, a policy recalibration often follows. This perceived sensitivity to economic pressure is a cornerstone of the taco trade theory. It is critically important, however, to recognize that the cycle of threatening and then retracting tariffs is not without cost. Even if the most aggressive tariff proposals are ultimately moderated or abandoned, the process itself inflicts considerable damage. The persistent uncertainty surrounding future trade policy has already had a chilling effect on global trade volumes and has acted as a drag on overall economic growth. Businesses worldwide become hesitant to make significant investments. Complex international supply chains face disruption and increased costs. Consumer confidence can also be negatively impacted by the unpredictable economic climate. A policy reversal does not fully erase these accumulated harms. This pattern of behavior, making strong, often disruptive pronouncements followed by later retractions or modifications, is not confined solely to the realm of trade policy. Similar dynamics have been observed in other areas. For instance, President Trump has publicly and repeatedly pressured Federal Reserve Chairman Jerome Powell. He has called for the central bank to lower interest rates significantly, and according to reports, even went as far as suggesting he might attempt to fire Chairman Powell. However, like some tariff threats, this particular threat against the Federal Reserve Chairman was also eventually walked back, contributing to a broader perception of policy unpredictability. Ultimately, the taco trade phenomenon, while perhaps offering short-term tactical opportunities for nimble traders, contributes to a more precarious and unstable global economic environment. The frequent and often abrupt shifts in policy make long-term strategic planning exceptionally challenging for businesses, both domestic and international. This pervasive climate of uncertainty can impede international cooperation on vital economic issues. It can also slow down the pace of innovation and investment. Consequently, it may act as a persistent headwind against robust, sustained global economic growth and shared prosperity among nations.